Do you think about your money as separate groups of funds for separate purposes? Or maybe use financial windfalls for something you wouldn't otherwise spend money on? If you do, you're not alone. Chicago Booth's Richard Thaler has dubbed this behavior mental accounting. It's the tendency people have to mentally sort their money into categories, often based on where it came from or what they plan to do with it. But mental accounting isn't just something regular people do to manage their household expenses. Behavioral economists have known since at least the 80s that mental accounting explains a lot about why investors behave the way they do when trading stocks. Economists have generally assumed that investors open a mental account when a stock is purchased and close it when the stock is sold. But no one likes closing an account at a loss. And according to researchers at USC and Chicago Booth, investors who sell one stock and then quickly reinvest in another actually don't close a mental account. They play a trick on themselves by placing the stock they sold and the stock they bought in the same mental account. Here's Sam Hartzmark, one of the economists behind the research.
So in the past, you sold an asset, and on the same day you bought a new one. When trading this new asset, we show that you're more likely to sell this new position at a gain, but relative to this old asset that's no longer in your portfolio, the original amount you invested.
So those investors who sell a losing stock don't have to think of the sale as realizing a loss. Instead, they think of it as rolling capital into a related investment. And by keeping that mental account open longer in this way, they avoid the psychological pain of closing an account at a loss. This can be really helpful. Here's Sam Hartzmark again.
We also show that on days that you do roll an account, so days that you sell something and buy something else, you don't actually exhibit one of the most ubiquitous behaviors in behavioral finance, which is what's known as the disposition effect.
It's the tendency of investors to sell shares whose prices increased, but keep the shares that are losing value. Not only that, but investors actually make better decisions when they roll a mental account.
So an investor has, say, 5 stocks in their portfolio. We see that they sold one of those stocks. How did that stock perform versus the other 4 stocks in their portfolio that they didn't decide to sell? The decision of what is sold statistically underperforms the portfolio if you buy another position, versus if you don't buy another position, the decision of what is sold does not seem to underperform those other positions.
Investors are making better decisions because they aren't trading based on the pain or joy that comes from closing a mental account. So when you're deciding whether or not to trade, do your best to avoid thinking about whether you're an investing genius by selling that gain, or an awful investor for selling that loss. It may just mean a more comfortable retirement.